Hey, Todd, how you doing? Shout out to you, Todd. Just trying to get everything situated for what's coming up. Damn, was another good move. Right at 11 o'clock. A nice call and a nice short. Oh, thank you so much, Jesse. Yeah, today was FOMC day, so I decided to take the morning off. What is these gigantic S's on the screen here? What is that? I don't like all these S's on here. Interesting. Big Money Lance in the building. Yeah, guys, I just took this morning off because of FOMC. I see already there was a nice move to the upside and a nice put. My goodness. All I saw was a 30-minute chart real quick. And beautiful move, but it seems like we're right back where we started from. Seems like we're right back where we started from. Did anybody make any money this morning? If so, please let me know in the chat. Did anybody get any money this morning? Closing cup, Lance says. What is these big S's on here? Y'all got those on y'all screens too? This big S? Think of Swim? Something new that they doing here? I don't like it. Don't like it. Clearing up my charts a little bit. Please stand by. Just clearing up my charts. I hope some of you guys was able to catch that move this morning. Seems like it was a very nice move. Now I'm adding my lines for today, areas of interest. Done that, now I'm going to clean it up a little bit. Starting with the daily chart. See, we have put in a very nice shooting star for the daily chart so far today. I see we're still in that controlled buying algo, the overall. Looking at the weekly chart. The weekly chart is red as well. Yeah, I don't know what that big letter S is. I don't know why it's up there. Absolutely beautiful trade at 11 o'clock. Who caught that? Please tell me somebody caught that. That was just unbelievably beautiful. Almost like the put, better than the call. The call happened faster. Nice $3 move. Did anybody take any trades this morning? Anybody take advantage of some of this beautiful liquidity that was provided this morning? In a controlled selling algo right now. I'm actually getting the chart together now. Okay. Red is for resistance. Green is for support. Purple is a monthly area of support. First of all, thank you, Tarzan. Tarzan SHQ. The top right corner is the daily chart. So let me start with that. The top right is the daily chart. Red is weekly resistance. Green is weekly support. Purple is monthly support or resistance, the purple lines. Bottom right is the weekly chart. So we have the daily, the top right chart. The bottom right, we have the weekly chart. Let me show that to you. Now on this weekly chart, this white line represents where the bulls lost control of the candle for the week. It defines an area where bears have taken over control. It's also an area that we want to be aware of, because if the price stays below that, then we will have another red week this week. If we're able to get back over that 603.4 area, then we'll have a green week. So the white area represents where the weekly candle flipped from green to red. So that's going to be a very important area. And what you have here on the chart is me identifying the computerized trading algorithms that is being used. As you know, the majority of trades by big institutions are done through computer algorithmic bots. And these bots leave a pattern. In the bottom middle is a 30-minute chart. To the left is the 15-minute chart. Then you have the 1 minute and the 5 minute in the middle. The 5 minute is primarily what we look at for trades. This morning, team, we had a beautiful control buying algo right out of the gate for a very strong $3 move. As you can see here, very strong control buying algo. We broke that at that 11 o'clock area where I showed you that 11 o'clock was a beautiful opportunity to take a put as we put in a lower high. Also, we came back to and broke through that 604 area, now going red on the week. We had a break and retest at 11.55 where the stock price again hit the very top of the selling algo and has come down. It's actually in the same area again right now, hitting the top of the selling algo as we have reached 145, 15 minutes before FOMC, 45 minutes before Q&A with Powell. But I tell you one thing, Tarzan, every line on this chart means something. Every single line. My entry model. I have several entry models. It all depends upon what I'm trading. If I'm trading a call or if I'm trading a put. I like to break and retest of certain areas. I look for imbalances. I look to see who's in trouble. I determine the area for the bulls and the bears where they may be stopping out. Whenever you have panic selling, that's always a great area to jump on the opposite of that trade. Panic selling by bulls causes the market to drop. Panic covering by bears causes the market to pop. So it all depends on what the setup is. This morning, I just identified a beautiful setup off hitting this intraday area of supply and then putting in a lower high, presenting a beautiful opportunity to the downside. I want to show it to you also on the Heikin-Ashi so you can see clear. Look how strong that move was this morning to the upside. All green candles. Very, very strong. And then we went sideways at the 6012 area. And from then we put in a lower high and have come down. Right now the market and I am just being patient until FOMC. But my entry model depends on what I'm trading. Depends upon if I'm taking a call. Depends upon if I'm taking a put. I always look to enter at supply or enter at support or enter at resistance or enter at demand. So absolutely not. I don't believe in prop firms. I believe you should trade your own money in a cash account. We don't believe in margin on this channel. We don't do prop firms. Learn the skill. Put your money at risk. Very transparent on this channel. When I do take a trade, I put it up on the screen for everyone to see exactly where I got in, exactly where my stop will be, and exactly where my profit target will be. We normally get on about 9:25 in the morning and run a live commentary from 9:25 till about 11:30. And then I typically come back around 1. Today was a little different because of FOMC. I didn't want to trade this morning. But I am coming back acknowledging some very beautiful trades, especially if we look here, even on the 30-minute chart. On the 30-minute chart, we have that beautiful 3-candle reversal that's straight out of the playbook. Right here at intraday. Supply, beautiful. You could actually extend this to yesterday to see how it worked out. Exact same area as yesterday. So when we got back up there to that same area today and put in this beautiful doji, and then we had trading underneath it at the 605 area, presenting a beautiful put using the top of this supply area as your stop. A lot of times you could just look left to find the areas of interest. So even if you were in a call, you already knew what area to take profits. And if you missed this call, it gave you a very beautiful opportunity to take a put. I want to highlight that for you guys, exactly the area that you're looking at right there where I put that arrow. That was a beautiful place for a put. And this morning, for those of you who wanted to take a call at that 598.4 area, it was a beautiful area to take a call. As this candle initially was red, hit this area of demand just like yesterday and bounced from that area. A lot of times all you have to do is look left to see exactly what the market is doing. And if we pull this over to the left, we can see this area right down to it. Red to green move, never stopped, never turned back from then. And so again, a lot of times you might want to look at the higher time frames, which is why we have higher time frames, so that you can look at the daily, the weekly, the 30-minute, the 15-minute, and then zero in on your 5 and your 1 minute for the best possible price on that execution after you have a larger time frame confirmation of the trade that you would like to take. Jesse said he's 1 for 1 for the day. Yes, sir. Tarzan said, what have you achieved through trading? I have achieved self-discipline. I have achieved learning myself, allowing myself to grow. Becoming a better trader makes you also become a better person as well. Being true to your word, sticking to your rules. It helps build character. So what I have achieved through trading is overall personal development, a better personal self-development. And that has extended beyond trading. But thank you for asking. Been going live every day, every single day, Tarzan, for over 2 years now. So if you're interested and want to learn a little bit more, please feel free to subscribe. And then once you do, go check out the channel. Go check out the playlist. Check out the live list. And see the consistency. Two things for certain, one thing's for sure. I don't plan to go anywhere, buddy. And again, I don't profess to be a guru. I don't have anything for sale. I'm not selling anything. I don't have a course. I just come on here with hard work, dedication, and the will and desire to win and be the best. And I look for people, Tarzan, who show up that are not prepared. I look for people who show up thinking this is a game. And when I find those people, I take their lunch. Come here playing, I'm going to take their lunch money. The trade has also taught me that only the strong survive. Only the strong eat. Everyone else is food. So don't come here playing. You'll get everything you want right here at the market. What about you, sir? How long have you been trading? What is your entry model? And how has trading been beneficial to you in your life and the lives of those people who mean much to you? Feel free to put it in the chat. Brooke Sanchez is in the building. Aubrey Myers is in the building. The gang is filing on in here this afternoon. Missed you guys this morning. Broke a little bit of what our normal routine is, but kind of wanted to be patient here on FOMC Day. But it was just a reminder to myself, as I always tell you guys, it doesn't matter what direction the chart is going in. For us, it doesn't matter because we're going to find profits in the charts. Four minutes to 2 o'clock. I'm going to go ahead and pull up the large 5-minute screen now. Guys, don't forget there is no trading tomorrow. Unfortunately, the markets will be closed tomorrow. Yeah, I know. I feel the same way. Alrighty, let's get ready to see if we can find something here. Powell speaking. Report coming out anyway. It's definitely time.
Most people think they know St. Martin from those viral videos of Maho Beach. You know, the ones where the
Okay, here we go. Everybody's got it up. Let me see.
Find out. Now. No change in the Federal Reserve funds rate, staying at a net level of 4.25% to 4.5%. Some really interesting stuff in the forecast. Let me tell you about the assessment of the economy first. They're saying the economy continues to expand at a solid pace. Unemployment remains low. Inflation is somewhat elevated. And they talk about the idea that swings in net exports, all that front running, is affecting the data. Now, the Fed forecasts increase the inflation outlook. They reduce growth for 2025. This is a second step in a row that the Fed has taken toward a more stagflationary forecast of higher inflation and lower growth. The forecast shows risks are to the upside for inflation and to the downside for growth. Let me give you some numbers here. 2025 GDP, now 1.4%. Down from 1.7, which was down from 2.1, so pretty much a very similar drop. Core PCE, 3.1, from 2.8, this is for 2025, from 2.5. So 2 big step ups in the outlook for core PCE this year. Risks on core weighted to the upside. Unemployment, 4.5, had been 4.4 before that, 4.3, so steadily stepping up on the unemployment outlook. Now, the question you really wondered about, which is, what did they do with the outlook for rates? Still 3.9% for this year. 7 officials did not want a rate cut at all. That's up from 4 in the prior outlook, but it remained the same because some other folks came down a little bit. 2026, the conversation Brian and I were having just before at 1 o'clock, they did eliminate 1 rate cut down to 3.6 from, or sorry, up to 3.6 from 3.4. And then again, that remains in place for 2027, 3.4 from 3.1. Inflation is seen declining in 2026. That's important. We passed through it, but not as much as previously forecast. Growth recovers in 2026, but again, less than previously forecast. The Fed says uncertainty remains high about all of its forecasts. The Fed said in the statement that uncertainty has diminished, but remains elevated. But if you look at the measures of uncertainty, which we talked about at 1 o'clock with Brian, those all remain elevated. Guys, back to you.
So very quickly, Steve, back to you, kind of writing all this stuff down. Higher inflationary expectations, lower growth. You mentioned the S word, stagflation. I would imagine that makes the Federal Reserve's decision-making a little bit harder, because that is not a great combination.
I think that's a good assessment, Brian. I do not see this Fed right now having made a further step towards cutting rates. It still could happen in September, but this forecast doesn't say, hey, we're incrementally, marginally, at least somewhat more confident about cutting rates in September. This one says, you know what? Whatever I had last time, I'm pretty much increasing the inflation rate and decreasing the growth rate by almost the same measure as I did from December to March. I did again from March to June.
All right, let's go now. Steve, stick around. Let's go back to our panel to get some reaction. Francis, I'm going to go to you. Electrical grid aside, let's talk about expectations. Because, again, no cut right now, but we knew that, okay? Not one person thought there was going to be a cut today. But when I'm looking at the end of this year into next year, the expectations, the dot plots, are all over the place. Where do you and RBC fall?
Well, we expect the Fed to cut later this year, but look at the balance of shifts in these forecasts. We're going from stagflation light to maybe stagflation moderate, and this is going to be the story for the U.S. economy. Inflation is just slightly too hot for comfort. A 3 handle is a psychological level that matters, and we're coming in below on trend growth. And all of the news that has happened in the last 2, 4, 6, 8 weeks is going to push us towards even higher inflation forecasts and probably lower growth. That's going to continue to put tension on this dual mandate. So we're going to focus a lot on this SEP and what these forecasts mean. But Brian, next time they're going to change again, and my expectation is for an even higher inflation number and an even lower growth number.
I'll go back to you quickly, Francis. Why do you think they're going to change again? Why are you so confident in that?
Well, they'll have to. I'm not sure why they say uncertainty has diminished. I wish I was that confident, but we have a series of ongoing shocks that have yet to be felt in this economy. And I think these numbers are still a little bit light on the inflation side and a little bit too strong on the growth side.
David Kelly, would you agree with that the future is fairly cloudy? We don't know what's even going to happen in the Middle East, inflation, energy prices, et cetera.
Yeah, I think it is very cloudy. I will say that since the last meeting, I think some of the tariff uncertainty has diminished. I mean, the tariff rates are not what they were on April 8th. But the thing that strikes me is if you look at that forecast for the end of this year, they think that 4.2% is the right unemployment rate in the long run, and they think they're only going to be 0.3 ahead of that. But they think that 2% inflation is the right number in the long run. It looks like they're going to be more than 1% above that. So, you know, Jay Powell said, you know, if they're both off track, we're going to look at how far they're off track and how quickly they get back to that track. And that suggests that they'll be very reluctant to cut rates until that inflation number comes down.
So, David, back to you. Again, and you nailed it, and I want to hear Jim's thoughts and Steve's and everybody's. When I hear inflation is expected to go up, my little brain immediately goes to higher rates, not lower rates.
No, I think they'll hold rates longer. I mean, I think they could hold rates all the way till the end of the year, because I think they know that, look, if this is tariffs, it will fade in 2026. Even if you get a sugar rush from fiscal stimulus from this bill going through Congress, that sugar rush will fade. Sugar rushes do. And so by the end of next year, that's a long way away, but by the end of the next year, the economy should be cooling down, inflation should be cooling down, and maybe then they can give us some lower rates. But right now, do not hold your breath waiting for low rates from the Federal Reserve, because they don't seem to have any intention of delivering them.
Jim, Karen, I can't see you right now, but are you holding your breath? I mean, do you think that could we be on hold for longer?
So let me start with the punchline. The punchline is that the Fed did not change their 2025 forecast for policy rates. To me, what that says is that they haven't really changed their position on anything. What has changed is the distributional outcomes, the possibilities, the confidence level that they have in the risks for inflation and employment. So what the Fed is basically saying is that the risks to inflation are skewed to the upside.
Thank you
the
for joining
risks
us, buddy.
to unemployment is also skewed to the upside. This is what I think is somewhat being confused as a stagflationary event for markets. This is really about a risk distribution. So if the risk distribution is suggesting that there might be higher inflation and that the unemployment rate might move higher, but they're unwilling to change their policy rate, then really what they're telling you is that the dispersion around what the Fed forecasters have has grown. And we've seen that. So you said that we went from 4 people calling for no rate cuts to now 7 people calling for no rate cuts. That's the big news here, is that we're moving towards a no rate cut environment going forward.
Yeah, and Steve Leishman, you've got obviously your Fed survey, so you know what people expect. And looking at it 4 months ago, 3 months ago, 2 months ago, now, and then looking out, are you experiencing that same level, to Francis's point, of sort of uncertainty? And in an uncertain environment, people tend, not always, but often, to do nothing because they don't know what to do.
Yeah, a lot to unpack here. First of all, the Fed survey was spot on, Brian. I'll just point out we were at 390 for this year and 355 for next year. So that really gave people a heads up in that Fed survey of where people thought the Fed might be for 2026. And I agree, there is a massive dispersion around outcomes, but the median official is still on that 3.9 or 2 rate cuts. I think there's good news and bad news here. The first good news is that, well, I'll give you the bad news first. The bad news is the Fed clearly believes inflation is to come from tariffs. They do not believe, at least I guess the median official does not believe, that we're out of the woods on tariffs. The good news on that is they do expect the tariff inflationary impulse to pass through the economy into 2026. And maybe even enough sometime in the second half that there's more clarity that they can eventually cut rates. The point is, right now, they did not make that movement today, but I think the point that was made earlier is right. They still see themselves going that way. They just ain't in any particular hurry to get there.
I love what Steve just said, Francis, because it reminded me that the tariffs are still a gigantic unknown. 2 months ago, that's pretty much all we talked about. Was tariffs. We're at the port of Long Beach. What's going to happen? The president kind of walked those back. Now we're talking about Iran and Israel, Middle East, inflation, energy, and yet the tariff situation is still hanging out there. I just don't know if I was a voting member of the Fed, how I would have any visibility whatsoever, not just around the Middle East, but around tariffs and how countries react.
Brian, I know this question is for Francis, but I want to just remind you of something. Do you remember at the last press conference, Powell challenged a reporter and said, "What would you write down?"
But that's why we get paid the medium bucks, because we don't actually have to do anything. That's the beautiful part, Francis. We don't actually have to make decisions. You do.
Brian, here's the thing. We know 2 things to be true. There's a lot we don't know. We don't know what the future of immigration policy is going to be. We don't know what that one big, beautiful bill is going to pass like. But here's what we know about tariffs. The average effective tariff rate in place is 14 to 15%. That is the largest trade shock in 100 years in the United States. That's what's in place right now. That is true and fact. Second thing we know is it takes a few months for tariffs to work their way through. Inflation depends how much inventory is in the system, but we know this from history. So what do we know? There's a major trade shock. You're right, we don't talk about it enough, and it has yet to play out. But it's not just tariffs, Brian. We have a big energy shock that just happened in the last few days. When I take a first scan here, it feels like that's not even factoring into the story here, and it needs to.
Yeah, well, because there's so much to focus on. We have a 4-hour show, Francis. Might be able to do it. We have like a half an hour. Very quickly, final comments from David and Jim as well. David and Jim, same question to both of you. David, I'll start with you. We just talked about all the uncertainty. What is David Kelly most watching next? What's the next big thing for you?
The exact details on this big stimulus bill, because people talk about it as being, reconciliation bill, but it's going to put a lot of stimulus into the economy in early 2026, depending on income tax refunds, because a lot of these tax cuts start on January 1, 2025. That means big refund checks, and that could sugar up the economy in the first half of next year. And I'm sure the Federal Reserve is looking at that, not just the tariff issue, because if it's just tariff inflation, it'll fade. But if it's tariffs followed by stimulus, then this inflation could last a while.
Yeah. Jim Caron, you and Morgan Stanley, what's the next big thing on your radar?
So I'm going to take a slightly out of consensus view, and I'm going to say that a lot of the news regarding tariffs right now, all of this uncertainty is going to start to pass as we go into the second half of the year, and it's going to become more like, known unknowns, essentially. So effectively, what I'm saying is that as the tariff uncertainty starts to pass away, we get the effective tariff rate, we know what it is. The risk is to the upside in the sense that if the economy does not deteriorate as much as people think that it will, then there's going to have to be a pretty big adjustment, not just in interest rates, but also in equity prices. And I think that upside risk is not fully appreciated right now. And we're seeing that in the skews in the dynamics for equity forecasters and even for where policy rates may actually end up being. So I think the boat is heavily tilted to the downside in risks, and I don't think that there's enough weight on the upside. And we want to play this in a balanced way, so diversifying a portfolio and repositioning ourselves to account for that is going to be very important.
Well, I know a lot of people have Steve Leisman because they've been investing in Europe, where we've had a lot of rate cuts. I know the president's talked about that. Very quickly, cherry on top this whole thing, I know you got to go into lockout, is the big takeaway, at least until we hear from Jay Powell, is the big takeaway that we are likely to go longer without rate cuts, or did I miss something?
Well, I was just interested in Jim's use of the word "these tariffs will pass." I was like, pass how? Like a kidney stone or a sailboat on a quiet summer night?
I was thinking gas, but actually, that's where my mind goes.
So I think there's two ways this could happen. I think Jim is right. Eventually, the market will have enough information to price this in and put a price on it. There is maybe an upside that I haven't mentioned here, which is that if the inflation forecast is 3.1 on core CPI, or core PCE, but the Fed is still forecasting the 2 rate cuts, does it tell us there's more tolerance by the Fed to still cut rates amid higher inflation? I think that might be a question that may be worthy of the Fed chair.
Well, you get to ask that question because you're going to go into the Fed lockup in about 15 minutes. That press conference will start, and you're going to get a chance to answer that as well. Jim, David, Francis, Steve, thank you all very much. We're going to go to Rick Santelli, but very quickly, folks, I want to show you something called the CME FedWatch tool. And here's how confusing it is for next year. And Rick, I know you can hear me, so we'll bring you in, and maybe you can comment on this because you're in Chicago, by the way. There are all these different expectations for rates maybe 1 year, the June meeting next year, 2026. There are 6 different levels between 2.75% and 4.14%. So 1.5% variance, which is a big deal for the Fed, in where the Fed may be. I guess my point, Rick, is it that cloudy next year?
I don't think it's that cloudy because I think that the weather projections are never very accurate. Just think about the past. How many rate cuts were built in? How few are built in now? In the end, I love our Chicago products, and I think it's interesting to know what investors think is happening down the road. But to think that the accuracy of anything in the Fed fund futures or option world that far in advance has a high degree of accuracy, well, it doesn't. It's only accurate given the inputs that we currently know. So I think it's always nice to know what investors are thinking, but I wouldn't look to that to be any sort of reality. I think the reality is that the markets, as Jim Karen said, maybe we're going to pass this by. I'll tell you what's passing by. Many people's 401ks are passing by golden opportunities. Look what the market has voiced over the last month with regard to equities and interest rates. And just today, if you look at the moves in the market, 2-year yields are a bit lower, but they're coming back. Only a couple basis. Markets haven't moved. Look at the dollar index. It's almost exactly where it was before the statement was read. What are the markets saying? They don't really see anything new here. And in terms of tariffs, I'll tell you what, the Fed used the word transitory, and maybe not in a good way. I'll use it. I think tariff agita is transitory. And the problem with that is that you won't be able to go back in time and do all the trades that uncertainty is keeping people from doing. I don't know if the future's ever been very certain, but I could tell you this, that the opportunities in many markets remain large because the uncertainties kept so many players on the sideline. In terms of the crystal ball and the dot plots, I never found them highly accurate.
Well, because they can be changed. If you don't like the dot plot, you just change your plot. So it's like, what time is dinner? 6 until it's 7, and then it's at 8, and then it's 7:30, right? You just keep moving around very quickly. Don't tell anybody, Rick, but here's the dirty secret. It's just between you and I. You've made more money by far investing in gold, a literally piece of metal, than you have in the stock market over the last 6 months.
Yep, but there's another way to look at it. If you haven't done gold and you haven't done the stock market, you haven't made much money.
Fair enough. But don't tell anybody that. Rick Santelli, thank you. All right, that is the Federal Reserve decision. Now we will wait to hear from the man in charge. That is Jay Powell himself. Press conference, 12 minutes, 25 seconds. That's when the press conference begins. We're going to take a very quick break. We're back with more right after this. The stock market up 100 points on the Dow, the Nasdaq up about 0.3%. No change in the equity markets. They are slightly higher, in part because the Federal Reserve made no change on interest rates. It kept rates exactly where they were, although the projections for future rate cuts came back just a bit. In other words, we may go the full year, we don't know, may go the full year without a rate cut at all. Joining us now to talk about it all, Loretta Mester, former Cleveland Fed president, now adjunct professor of finance at the University of Wharton, also a CNBC contributor, and we are darn glad that you are here, Loretta. If you were still on the Fed, what would your decision and expectation for rate cuts be?
Yeah, I would have probably already been at one cut as opposed to two, so I may not have changed my SEP. Remember, the SEP, the one that we had before was in March, and that was before the April 2nd announcement on tariffs. So it moved kind of the way you would have expected, right? Growth, right, they took down a bit. Inflation, they took up. And even though the median, and remember, these are individual forecasts, and then they compute a median after the amalgam of those forecasts. Even though that didn't change, the weight sort of moved toward one cut as opposed to two. So again, we're a higher path for policy this year and next year. So all that I think is expected. The one thing I didn't expect is for them to say that uncertainty has diminished. I would have thought they would have just said it remains uncertain, not that it increased more. But so that was a little bit of a surprise. But I also think that's because the economy has been pretty resilient. I mean, the labor market is holding up well. Growth is rebounding from the very, the negative reading we had in the first quarter. So in that sense, there's more clarity about the strength of the economy. But the question is, what's the economy going to look like in the second half of the year?
Can you answer your own?
They're telling us.
Answer your own question.
No, I think what they're telling us is they see that these, even though we don't know the size of the tariffs and, where they're ultimately going to land and their effects, that they are going to hold here for now because the impetus from those tariffs are higher inflation, at least for a time, and a bit weaker growth and a little bit higher unemployment. And they need to do what they have to do, as the chair has been telling everyone, to make sure that inflation and inflation expectations remain anchored. So even though they may look through the price increases that come from tariffs, there's no compelling reason for them to make a change now in the policy rate with the economy performing pretty well, and there's still uncertainty about the second half. So I think they made the right move today by doing nothing with the funds rate. And I think the hold and see until they get a little more clarity. As one of your guests had said, we also have the budget bill working its way through Congress, and that'll be part of the outlook as well. So I know you were talking, Brian, they can just change the those dots whenever they want.
You were the one making the plots, the dots on the plots.
Right, but remember, we change them. Any forecaster will change them based on incoming information and how that informs their outlook. So I don't think it's a bad thing that the forecasts are responding to incoming economic data. I think that's a good thing. And I think it's the change from one SEP to another that's very informative. And I think today we got informed that, the bulk of the committee is thinking that we're going to need a slightly more restrictive policy stance than they had thought at the time of the March meeting. I think that's very clear in this.
And I don't.
This SEP.
I agree. I mean, you change your forecast for anything based on your known information at the time, right? My flight will land at 4 p.m. Then it's delayed because you chose to fly out of Newark, sadly. So you got to call and say, well, I'm going to be delayed. I'll land at 6. You change your expectation based on what you have at the time. I guess my point, Loretta, was when I look at the CME's FedWatch tool for next year, I see 6 different expectations, all within a relatively similar band, variance a little bit, of ideas. These are some of the smartest, like you, economists in the world. And I guess my point is there doesn't seem to be a lot of visibility to next year.
Well, I think that underscores what the chair has been saying, which is there's a lot of uncertainty still here. But when you're doing this kind of policy making, you're doing two things. You want to minimize the risk that you're going to make a policy mistake, and you also want to minimize the cost of any policy mistake you might make. So right now, it's not that costly to hold, right?
Yeah.
The economy is doing well. The unemployment rate is low. Growth in employment is holding up pretty well. It's moderated, but that was to be expected, right? And even the latest inflation news is pretty
people that are
good.
watching.
So with that environment, you don't have to move right now, but you've got to be prepared if the economy changes in the second half to be able to respond. And I think they are in a position to be able to respond once they see how the economy is evolving. Before this, I know there's a July meeting, but think about the next September meeting where we're going to get SEPs. You're going to also have a lot more economic data coming in.
Well, the bond market, somebody said earlier in the show, they don't buy barrels of oil, Loretta, but they use gasoline. I thought that was well said because most of our viewers and listeners, they're not trading interest rate futures, but they might want to buy a home. And they're watching mortgage rates. And the bond market already did move.
No, that's true. But also think about the way people's expectations about future inflation are formulated. The gasoline price is one of those prices that really matter in terms of inflation expectations. So what I expect to hear in Jay's press conference today is that the Fed is still, very focused on making sure that it does policy that will actually support that anchoring of inflation expectations. And I think that's part of what they're doing with this hold and see strategy.
Loretta Mester, we're sure glad you're on our team. CNBC contributor, super smart. Thank you.
Thanks, Brian.
Thank you very much. All right, let's bring in now our senior markets commentator, Michael Santoli, as we await Jay Powell. Mike, we got an empty podium, but soon to be filled by Jay Powell. Is there anything the market wants that podium and the person behind it to say?
I think the market always wants the Fed chair to convey a sense of flexibility and willingness to move relatively quickly in response to data, in particular if the economy does weaken from here. I'm also interested to hear how Chair Powell characterizes the summary of economic projections, the dot plot, because there are times when he says, he tries to dismiss it. We just write this stuff on a piece of paper. It's not an authoritative plan or outlook. It's not definitive guidance. And there are some times when he kind of leans back on it and says, look, the committee is not prepared to work yet. It's interesting that you have very few members below the median in terms of rate cuts. In other words, who think there could be more than 2 rate cuts this year. And you have 9 members who think there could be none or 1. And so to me, the skew is the barrier is pretty high for cutting rates right here. An investor has to assume the Fed's kind of not part of the game for the next 3 months because you got an end of July meeting, you got Jackson Hole, then you're talking about September, which means good news for the economy is what you're rooting for. Good news is good news now.
20 seconds. Softball. How much does the Federal Reserve even matter right now?
I don't think they matter a ton right now. It's market rates. It's like the longer-term part of the Treasury curve. And because the Fed has intentionally taken itself to the sidelines and trying to make full use of this luxury of what they perceive as a luxury of patience right now, because they don't see any emergency on either side of their mandate. You can argue about that, but they don't see it.
I would say the man behind the curtain, but he just came around the curtain. Federal Reserve Chair Jerome Powell.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I'll have more to say about monetary policy after briefly reviewing economic developments. Following growth of 2.5% last year, GDP was reported to have edged down in the first quarter, reflecting swings in net exports that were driven by businesses bringing in imports ahead of potential tariffs. This unusual swing has complicated GDP measurement. Private domestic final purchases, or PDFP, as we call them, which excludes net exports, inventory investment, and government spending, grew at a solid 2.5% rate. Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.4% this year and 1.6% next year, somewhat slower than projected in March. In the labor market, conditions have remained solid. Payroll job gains averaged 135,000 per month over the past 3 months. The unemployment rate, at 4.2%, remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.5% at the end of this year and next, a bit higher than projected in March. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as the driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 3%, somewhat higher than projected in March. The median inflation projection falls to 2.4% in 2026 and 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to trade, immigration, fiscal, and regulatory policies continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It's also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year, the same as projected in March. The median projection declines to 3.6% at the end of next year and to 3.4% at the end of 2027, a little higher than the March projection. These individual forecasts are always subject to uncertainty, and as I've noted, uncertainty is unusually elevated. And of course, these projections are not a committee plan or decision. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on issues related to assessing the risks and uncertainties that are relevant for monetary policy and the potential implications for policy, strategy, and communications. Our review includes outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference that we held last month. We are open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up any modifications to our statement on longer-run goals and monetary policy strategy by late summer. After that, we will consider enhancements to our suite of communications tools, including the SEP. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Colby Smith with the New York Times. To what extent has the more limited impact from tariffs at this stage on inflation changed your view on what the ultimate economic fallout will be from these policies and the timing of when they will materialize in the data?
So we've had 3 months of favorable inflation readings since the high readings of January and February, and that's, of course, highly welcome news. Part of that just is that services, core services, both housing services and non-housing services, have really been grinding down toward levels that are consistent with 2% inflation. So that's the good news. We've had goods inflation just moving up a bit, and of course we expect, as you point out, we do expect to see more of that over the course of the summer. It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. So we're beginning to see some effects, and we do expect to see more of them over coming months. We do also see price increases in some of the relevant categories like personal computers and audiovisual equipment and things like that that are attributable to tariff increases. In addition, we look at surveys of businesses, and there are many of those, and you do see a range of things, but many companies do expect to put all or some or all of the effect of tariffs through to the next person in the chain, and ultimately to the consumer. Today, the amount of the amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are as we learn more. And we think our policy stance is in a good place where we're well positioned to react to incoming developments.
So in terms of how we should interpret the rate cuts penciled into the SEP, is this reflecting that there's this expectation that underlying inflation will just stay well enough contained that allows the committee to eventually move ahead with those cuts? Or is it about responding to a deterioration in economic activity, let's say? I mean, how should we make sense of the forecast?
So if you look at the forecast, you will see that people do generally expect inflation to move up and then to come back down. But we can't just assume that. Of course, we don't know that. And our job is to make sure, one of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
Hi, and thanks, Chair Powell. Howard Schneider with Reuters. If you look at the rate path starting in December to today and adjusted over the full time horizon you've got there, you've taken about a quarter point per year out of your projected path, and you end at a higher rate at end 2027 than you would have in the prior forecast. Is that a result of a sense that tariffs will lead to more persistent inflation? Is it a result of reassessments of where your short-term neutral rate is? Why are you on a slower path now?
So I would focus most on the nearer term. As you get out to the later years, it's hard for anybody to know where the economy is going. You didn't see people moving their longer term, estimate of the neutral rate, for example, at this meeting. So and those things are probably slow moving. So I think if you look at what's happening here since March, this is since March, right? You see a little slower growth, just a tiny tick up, a 1/10 tick up in unemployment, and you see inflation moving up 0.3. And by the way, it was a similar move from the December SEP to the March. So that's what you see. You see the effects of tariffs. I think we learned in April, after the March meeting, that substantially higher tariffs were likely. And then since then, the estimates of where the tariffs will be have actually moved back down, although still at an elevated level. So we're adapting in real time. And what you see is an accumulation of individual assessments.
But you say in the statement that risks have diminished on that front, but the July 9th, drop dead date for all the Liberation Day tariffs is still out there and unresolved. You've got now exchange of missiles between two Middle East adversaries with a possible U.S. involvement. How can you justify saying that risks have diminished?
So what we said was that uncertainty uncertainty about the economic outlook has diminished but remains elevated. Many surveys say that. They do. So, and that's actually a line from the Teal book, which you can see in 5 years. Remember to check that.
Maybe the world will be over.
No, but if you think about it, tariff uncertainty really peaked in April, and since then has come down. And that's really what that's just acknowledging. It's diminished, but still elevated. That it's uncertainty. So I think that's an accurate statement.
Thank you. Chris Rugaber at Associated Press. There is an argument out there in favor of cutting rates more immediately. Inflation has continued to cool and is back at to roughly 2% despite the tariffs. And I guess I also wanted to ask about cracks in the job market with gross hiring slowing, concentrated in just a few industries. We've seen some housing data, including this morning, that has been pretty weak. Do you see any concerns that the economy is weakening and that is a reason to cut rates going forward?
So we do of course monitor all those things. I think if you look at the overall picture, what you're seeing is 4.2% unemployment and an economy that's growing at a rate hard to know given the unusual flows in the first quarter, but it appears to be 1.5%, 2%, maybe a little better than that. Sentiment has come up off of its very low levels. It's still depressed. So you can point to things. The housing market is a longer run problem and also a short run problem. I don't think it's indicative of basically the situation is we have a longer run shortage of housing, and we also have high rates right now. I think the best thing we can do for the housing market is to restore price stability in a sustainable way and create a strong labor market, and that's the best thing we can do for the housing market. You asked about the job market. Again, look at labor force participation, look at wages, look at job creation. They're all at healthy levels now. I would say you can see perhaps a very, very slow continued cooling, but nothing that's troubling at this time. But we watch it very, very carefully. So overall, again, the current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments, and for now, and we'll be watching the data carefully.
Well, just quickly on, given that there are concerns inflation will rise, but there is the alternate scenario that tariffs would create demand destruction and slow growth sufficiently, and that would perhaps keep a bit of a lid on inflation. Do you see odds of that scenario? What kind of odds do you see of that scenario coming true, and how many months of cool inflation would you need to see before concluding that maybe that lower inflation scenario is taking place?
So this is very much the conversation we had today and yesterday. There are many, many different scenarios, many combinations of scenarios where inflation does or doesn't prove out to be at the levels we think, and where the labor market does or doesn't soften. And I think what you see people doing is looking ahead at a time of very high uncertainty and writing down what they think the most likely case is. No one holds these rate paths with a great deal of conviction, and everyone would agree that they're all going to be data dependent, and that you can make a case for any of the rate paths, I think, that you see in the SEP. And we do this once a quarter. It's a hard thing to do particularly at this time, but it does reflect. If you see somebody writing down a rate path that involves cuts, that's them saying, yes, I think we will get to a place, more likely than not, where cuts will be appropriate. And it could be a joint probability of a number of possible outcomes. Again, remember how much uncertainty we face, though.
Thank you. Mr. Chair, I wonder if you could describe for us some of those scenarios. How do you get to a place? I'm noticing that the uncertainty levels in your forecast are very high. How do you get to a place where you have the confidence in the outlook for, say, inflation and or growth or the unemployment rate? How many months does it take, and what do you want to see in the data to get to that level of confidence to actually reduce rates off the restrictive level?
So it's very, very hard to say when that will happen. We know that the time will come. It could come quickly. It could not come quickly. As long as the economy is solid, though, as long as we're seeing the kind of labor market that we have and reasonably decent growth and inflation moving down, we feel like the right thing to do is to be where we are, where our policy stance is, and just learn more. And in particular, we feel like we're going to learn a great deal more over the summer on tariffs. We hadn't expected them to show up much by now, and they haven't. And we will see to the extent to which they do over coming months. And I think that's going to inform our thinking, for one thing. In addition, we'll see how the labor market progresses. So at some point it will become clear. I can't tell you exactly when that will be. And meanwhile, we'll be watching the labor market very carefully for signs of weakness and strength, and tariffs for signs of what's going to happen there. And of course, there are many developments ahead. Even in the near term, developments are expected on tariffs. So I think we don't yet know with any confidence where they will settle out. We have an estimate, and I think all estimates are now pretty close together, but it's again highly uncertain.
When you say estimate of the impact of tariffs on the core PCE, is that what it is? And could you share that?
What you start with is what's the effective tariff rate overall, and people are managing to that. But the pass-through of tariffs to consumer price inflation is a whole process that's very uncertain. As you know, there are many parties in that chain. There's the manufacturer, the exporter, the importer, the retailer, and the consumer. And each one of those is going to be trying not to be the one to pay for the tariff. But together, they will all pay for it together, or maybe one party will pay it all. But that process is very hard to predict. And we haven't been through a situation like this. And I think we have to be humble about our ability to forecast it. So that's why we need to see some actual data to make better decisions. We'd like to get some more data. And again, in the meantime, we can do that because the economy remains in solid condition.
Nick Tamaros of the Wall Street Journal. Chair Powell, I guess I'm wondering if you could explain a little bit more the divergence we see in the dot plot, particularly around the 2025 rate projections. I realize this is, you have one group of officials that are putting down no cuts, another that are putting down more than one. And again, recognizing that could be difficult to summarize, but is it a matter of people having a different outlook or a different reaction function, a different commitment to defending against another inflation mistake? How did that play out over the last 2 days?
So you're right. This is often the case. We have a pretty healthy diversity of views on the committee. We did have strong support for today's decision and broad agreement that our policy stance does leave us in a good place. But I would point to two factors, and you mentioned them. The first is just that parties have a diversity of forecasts. and they do align with where their dots are. So if you have a higher inflation forecast, you're going to be less likely to be writing down, more cuts. But remember, as we see more data, we're going to learn more about where inflation is headed, and that means when it is time to look at resuming our normalization process, the differences you see should be smaller because we'll have seen actual data. Right now, it's just a forecast in a very foggy time. So that's the first part, is forecast. Secondly, people can look at the same data and they can evaluate the risks differently, as you know. And that includes, the risk of higher inflation, the risk that it'll be more persistent, the risk that the labor market will weaken. People are going to have different assessments of that risk. So that you put that in there too. So those are the two ways that the two things I think that drive these things. Remember though, as I mentioned earlier, with uncertainty as elevated as it is, no one holds these rate paths with a lot of conviction. So that's really where it is. It's a function of those things. And I think as the data come in, you should see those differences diminish.
If I could follow up, you've said the policy is in a good place and that it's modestly restrictive. Given all the uncertainty you just talked about, tariff levels, uncertainty around the pass-through, is it price increases versus margin compression, some of the softness that Chris talked about in labor and housing, why wouldn't it be better to have rates at a more neutral setting as the economy heads into this period of very high uncertainty?
So if you just look backward at the data, that's what you would say, but that's not. We have to be forward-looking, and the thing that every forecaster, every outside forecaster, and the Fed is saying is that we expect a meaningful amount of inflation to arrive in coming months, and we have to take that into account. So I think a backward-looking look would lead you to a neutral stance, but we can't. We have to look at that, and because the economy is still solid, we can take the time to actually see what's going to happen. There's a range of possibilities on how large the inflation effects and the other effects are going to be. So we'll make smarter and better decisions if we just wait a couple of months or however long it takes to get a sense of really what is going to be the pass-through of inflation and what's going to be the effects on spending and on hiring and all those things.
Michael McKee from Bloomberg Radio and Television. Your friend down at 1600 Pennsylvania Avenue continues to lob insults in your direction, and I'm wondering, given now that the Supreme Court has maybe carved out the Fed from some of the legal implications of that, whether this is just noise that the markets and everybody should ignore until your term is up, or whether you worry that it could lead to more pressure on confidence on Wall Street, on consumers, about the outlook for the economy.
Okay. From my standpoint, it's not complicated. What everyone on the FOMC wants is a good, solid American economy with strong labor market and price stability. That's what we want. We think our policy is well positioned right now to deliver that and to be able to respond in a timely way as the data lead us around. The economy's been resilient, and part of that is our stance. And again, we think we're in a good place on that to respond to significant economic developments. That's what matters. That is what matters to us. Pretty much that's all that matters to us.
I need to ask, assuming you are not reappointed, would you stay on as governor when your term as chair ends?
I'm not thinking about that. I'm thinking about this.
Hey, team. Who caught some of that beautiful put as you saw the market breaking from that?
I guess with workplace raids increasing, picking up significantly, what kind of effect would that have on the labor market?
Sorry, with what picking up?
Workplace raids.
Every line on this
so you're asking
chart
immigration.
means something.
Yeah.
He was asking me about the white line.
I wouldn't want to speculate. One way to get at that from an economic standpoint, we of course don't comment on immigration policy. It's not ours to make or comment on. But what you see is an unemployment rate that has been really solid and at a low level, not really increasing. It's been in a good range and well within the range of mainstream estimates of maximum employment. And that means part of that is that labor demand and labor supply are kind of moving down at the same rate. Labor demand is softening. You see that in job creation, but it's still kind of at a healthy level. And labor supply is diminishing because the immigration numbers that we see are much lower than they were. So those two factors, supply and demand, that's what has kept the labor the unemployment rate in a reasonably stable place.
So you will be in a proper
The other thing I wanted to follow up on is if you could elaborate on the potential changes to the SCP that you suggested were part of the framework
as
review.
we go from one level to the next
the framework
line
review really
that I
has
have called
two
out.
tracks,
Perfect.
right? The first track is our policy framework that is reflected in
Yet
the
again.
consensus statement.
And all
And
praise.
we've said that we would finish that and announce it by the end of the summer.
But I know we have
So
these people who
we're
like to
well
come
along
on
in that
here.
process. We've had the meetings that we need to
know
have, and we're
sometimes
now
they get
going to
sent
be
by
going
other
into,
people.
pardon me, into discussions
exactly
about,
the one.
specific changes to language.
respond
So
to every
that's the
I
framework
will
part of it.
explain
The second
every
part of it is
trade
our
that I take.
communications tools
I'm
and
completely
practices.
transparent and have
Pardon me.
been for 2
And
years.
that part comes next. Okay, that's what we're going
Lot
to
of
do in the
things
meetings
you can
this
say.
fall. Actually, what we did at this
can't
meeting,
say.
though, is we sort of prepared the
100%
ground for that. We had
absolutely
a meeting where we talked at a high level about a number of ideas.
And these
The SCP
lines
is
don't
part of it.
come with this
Many other ideas. It's sort of how do we
put
think our
these lines on
communications
the
can be
chart.
improved? There are a number
They
of
didn't come
ideas. People offered a
preset.
really
Charles Schwab
great
didn't give you these
conversation.
lines.
Number of ideas, but
Abdul
we're going to look at
Shabazz
those
gave
with staff briefing and a lot of thought
Gave you these
in the
algos.
fall.
Put
And
some
I would say when it
respect
comes to
on my
changing
name,
communications,
put some respect on this team.
I would only
Some real
support things
change
really that only
in
implement things that
every
have very broad
sense
support.
of the word.
And also, you want to be really careful
In
because
fact, I'm even
I
done
think our
talking
communications
for
are pretty
today.
well received. They're not
I'm not gonna
broken.
even get back
So
on this channel.
more is not necessarily better, but better is better. So we're going to be looking at ways to do
well.
things that will improve the clarity of what we
And
do for the
remember,
benefit of the public.
Every line, every color on my chart means something. It would
Thanks, Chair
behoove
Powell.
you
Kellyohgee, CBS News.
get
You're
hit real
famously
quick. You
known
better
as
get
the
right
guy that
before
makes
you get
decision
left.
based on
Abdul
data
Shabazz,
instead
I
of
know.
speculation. You've said today in the inflation data is in a good place. We don't know how tariffs are going to impact prices going forward. That's uncertain. But I've got to go back to the last time that you cut rates in December, and there was still the what if of tariffs. So what made you feel comfortable cutting then when inflation was higher than where it is today and you didn't cut today?
Well, the forecast for inflation in December was 2.5. Core PCE for 2025, the forecast was 2.5%, which was a good inflation forecast. I think what we've learned is that, and this was long before we had any idea of what the actual policies would be. We've learned that tariffs are going to be substantially larger than forecasters generally thought. And, we don't, our forecasts are generally not particularly different from those of other, well-resourced forecasting operations. So what we learned, and particularly in April, was that very substantially larger tariffs were coming and that would mean higher inflation. That's what happened. And so you saw 2.5% forecast in December, you saw 2.8% in March, and you see 3.1% now. So it's 0.6 higher inflation for 2025, and that's a big part of the change, and that's due to the effects of the tariffs that are, we don't know where they're going to land, but it's pretty apparent they're going to land higher than outside forecasters were really guessing at the end of last year.
My follow-up to that, I think consumers, right, we're looking for relief on rates when it comes to mortgages, car loans, small businesses want to take out more manageable loans. When you look at the cumulative inflation over the past 5 years, prices have risen over 20%. It's been a rough road. So what is the tipping point then for the wait and see approach in terms of how much it's going to help versus when it hurts the American consumer?
Well, I mean, we're trying to restore price. The best thing we can do for the public that we serve is restore price stability. If we can, and we will, restore price stability, meaning 2% inflation on a durable, sustainable basis. That, and also maximum employment. If we restore those things, that's the best thing, and that is our goal. The best thing we can do for the American people, for households and businesses, that is the ultimate thing that we can deliver. And they can make their decisions without having to think about inflation all the time. So in the meantime, we have to keep rates high to get inflation all the way down. They're not very high, let's be honest. I would say policy is modestly or moderately, probably modestly now restrictive. If you look at the economy, it's not performing as though it were performing under very strict monetary policy, very restrictive monetary policy. So I would say probably modestly restrictive. And so what it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building, because if you see what's happening with non-housing services and housing services, which are the other two big pieces other than goods, those are coming down really nicely now. So I think we have to learn a little more about tariffs. I don't know what the right way for us to react will be. I think it's hard to know with any confidence how we should react until we see really the size of the effects, and then we can start to make a better judgment. So that's what we're doing, and I think we can take the time to do that because unemployment is 4.2%. Wages are moving up. Real wages are moving up at a healthy clip now, and inflation is 2.3% headline inflation over a 12-month basis. So it's a good economy and a solid economy with decent growth.
Thank you, Chair Powell. So you're saying that uncertainty has come down, the economy is moving at a solid pace, inflation has come down over the past 3 months, and this is all moving in the right direction. So are you indicating here that Americans should expect some sort of economic pain in the second half of the year?
I'm not saying that at all. From our standpoint, what I can say is that the U.S. economy is in solid shape. Inflation has come down. The unemployment rate remains at 4.2%. As I mentioned, real wages are moving up. It's a good job creation is at a healthy level. Unemployment, again, as I said, low. Labor force participation in a good place. So, and what we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. And there's a lot of uncertainty about that. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting a pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs, and it will be someone in that chain that I mentioned between the manufacturer, the exporter, the importer, the retailer, ultimately somebody putting it into a good of some kind or just the consumer buying it. And all through that chain, people will be trying not to be the ones who pick up the cost, but ultimately the cost of the tariff has to be paid, and some of it will fall on the end consumer. We know that because that's what businesses say, that's what the data say from past. So we know that's coming, and we just want to see a little bit of that before we make judgments prematurely.
And follow up on that. So you spent years though talking about how you're data dependent, and be a little more direct on this. Now you're making decisions looking forward. Doesn't the data you're seeing today indicate there should be a rate cut?
No, I mean, your monetary policy has to be forward-looking. That is elementary. You've got to be looking. I always talk about the incoming data, the evolving outlook, and the balance of risks. We say that over and over and over again, right? So it's always forward-looking. If at the very beginning of the pandemic, we cut rates to zero immediately. Nothing had happened. We just knew that it was going to be really bad, right? So we took very aggressive forward-looking because we knew things were going to be unusually difficult. So, of course, this is something we sort of know is coming. We just don't know the size of it. And again, the economy seems to be in solid shape. So the labor market's not crying out for a rate cut. Businesses, were in a bit of shock after April 2, but you see business sentiment. You talk to business people now. There's a very different feeling now that people are working their way through this, and they understand how they're going to go, and it feels much more positive and constructive than it did 3 months ago, let's say. So, again, we think that our current stance of monetary policy is in a good place.
Thank you. Amara Mokway with Bloomberg. Chair Powell, in February, you told Congress that the Fed is, quote, overworked, maybe not overstaffed. Then in a memo to staff in May announcing a deferred resignation program at the Fed, you said you wanted to ensure that the Fed was, quote, right-sized. Those two statements appear to be at odds with one another. Could you explain what changed in the roughly 3 months between those statements that made you decide that staff levels at the Fed should decline?
I don't see them at all as intention. So I was asked, is the Fed overstaffed? And I said no, and I sort of said as a pun, overworked but not overstaffed. People do work extremely hard at the Fed, and I know they work hard at Bloomberg too. So, but we work hard, but I would say this. So we are careful stewards of public resources, and sometimes you need to show that. So there have been several times in our history, modern history, where the Fed has said, you know what, we're going to do a buyout. We're going to show the public, we're going to demonstrate that we are good stewards of public resources. So we thought, and I thought, that this is a time when we can, we grow at about, our headcount has grown at about 1% a year. So over the course of a couple of years, we're doing a careful scrub of the board and all the reserve banks, and we're going to find 10% of employees who can do something else, where we can streamline our operations, and we think we can get there in a couple of years. We think we can do that, and we think this is without taking risk to carrying out our critical missions. So this is something you do very carefully, thoughtfully, and you do it, again, respecting that we have critical missions to carry out. I've had experience, a lot of experience in my prior careers, with headcount reductions and things like that, and this is how you do it professionally. You do it carefully, thoughtfully, with a lot of planning, and you do it over a period of time. And I think the Fed will be fine. I think no one will notice any decline in our ability to carry out our missions. And I think it's just us wanting to demonstrate to the public that we are actually good stewards of their resources. We're effectively wiping out 10 years of headcount growth with this. So, I mean, we wanted to show that, that we're good stewards.
How is progress on reducing headcount going so far? Are you on track to meet the goal?
We're just at the very beginning. As you know, we're doing a buyout program. We're going to hit that goal. I think many organizations find that they can do this. You don't want to do it every year or anything, but you can do it at intervals, and you wind up not interfering with your ability to perform your jobs.
Chair Powell, Claire Jones from the Financial Times. As you're no doubt aware, the Senate Finance Committee has tabled its version of the reconciliation bill this week, and I was wondering if you could tell me a little bit about the tenor of the debate at the FOMC over the past few days on fiscal policy and the degree to which that influenced people's projections for 2026 and beyond. Thank you.
Yeah, so, we don't sit around and debate or really discuss. We take fiscal policy as fully exogenous. And so we actually, really didn't talk about the bill or the contents of it. It's still evolving. When it gets closer, remember also we have a very, very large economy, and that the effects will be at the margin. I expect that they may already be in, but they will be in by the next meeting. We'll make an estimate. But it's not a major thing. It's nothing that we discuss. It may have been mentioned a couple of times, but as something that's coming in. But I think the outcome is, we don't know the outcome yet there, so hard to be real specific.
Neil. Thanks, Chair Powell. Neil Irwin with Axios. There have been some cutbacks in economic statistics collection in the last few weeks, worries that long-running problems around funding and response rates may be getting worse. How much is this concern on your radar? How much confidence do you have that the gauges you're watching to assess the economy are reliable right now?
Two things. One, the data we get right now, we can do our jobs. I'm not concerned that we can't do our jobs. That's not the point. The point really is that we are starting to see layoffs and important gatherers of data are saying that they're having to cut back on the size of their surveys. That's going to lead to more volatility in the surveys. I think we should take a step back and, from our standpoint, and I think the standpoint of businesses and governments and everyone, having really good data on the state of the economy at any given time is a huge public good. It helps, it not just doesn't help the Fed, it helps the government, it helps Congress, it helps the executive branch. More importantly, really, it helps businesses. They need to know what's going on in the economy. The United States has been a leader for many, many years in this whole project of measuring and understanding what's happening in our very large and dynamic economy. And I hate to see us cutting back on that, because it is a real benefit to the general public that people in all kinds of jobs have the best possible understanding of what's happening in the economy and hence what's likely to happen. It's very hard to measure what's going on in the U.S. economy. If you read, there was a book called, it's really remarkable how many things you need to understand to estimate U.S. GDP. Very, very difficult. And it's so important that we get it right. I just would say it's not a place to I would want to keep investing in that, for the good of the general public.
Victoria. Hi, Victoria Guida with Politico. So you're conducting this monetary policy strategy framework review, but next year we're supposed to have a new Fed chair, and I'm wondering if that affects at all the way that you're approaching this. How do you ensure that this framework will actually be durable?
The framework document goes back to 2012, and it's the committee's document. It's not like we're going to invent a brand new way to do things. It's been an evolving document, so it shouldn't depend on who the chair is at all. It should depend on what's happening in the economy and what the committee wants to do. So, yeah, it isn't really tied to any particular chair. And we used to renew it every year. Now we do it every 5 years. So, but I don't think I've never heard anyone raise this issue that a new chair might want to come in and go in a completely different direction. I really don't think that's right. But but that's not going to be up to me to decide.
Is that affecting at all who you're consulting with?
Not at all. Not in any way.
Yeah.
Thank you, Chair Powell. Matt Egan from CNN. Relatively low gas prices this year have helped drive down inflation in recent reports, but that trend is starting to reverse given the crisis in the Middle East. How are you thinking about how the Israel-Iran conflict will impact the economy, especially inflation? And what lessons were learned during the 2022 period when another conflict, the Russia-Ukraine war, sent oil and gas prices skyrocketing?
So, of course, we're watching, like everybody else is, what's going on. I really don't have any comment on that. Possible that we'll see higher energy prices. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. Those things don't generally tend to have lasting effects on inflation, although, of course, in the 1970s, they famously did, because you had a series of very, very large shocks. But we haven't seen anything like that now. The U.S. economy is far less dependent on foreign oil than it was back in the 1970s. So, but there.
A quick follow-up. I've just got to ask you about artificial intelligence. Some technology executives have recently been warning that AI could wipe out a large chunk of entry-level jobs and significantly increase the unemployment rate. I'm wondering how concerned you are, if at all, about the threat that AI poses to employment.
So this is the question. The question really is, will AI be more augmenting labor or replacing labor? And I wouldn't, we all see those announcements, including one today. I wouldn't, overread a couple of data points, because, AI should be creating jobs at the same time. It may be replacing, maybe doing both. Anyone who's done any work with AI will have been a little bit stunned at how capable it is. And it's just a different thing. So I think this is something that certainly has transformational potential. And probably we're in the very early stages of it. They say what you're seeing now compared to what you'll see in 2 years is going to be very different and even more effective. So I think it's really hard to know. Of course, there are optimists who feel like it's going to make everybody much more productive. And there are those who think it's going to replace an awful lot of jobs right across the income spectrum, white collar, blue collar, and everything. So I just don't know. We don't have a house view on that, but this is going to be a very important question for some time.
Greg.
Thank you. Greg Rapp from MarketWatch. I was wondering if you could step back a little bit, Chair Powell. There's a spate of articles and a lot of op-eds now in the newspapers saying that the U.S. economy and the global economy is going through this profound change, akin to the end of the Bretton Woods era in the 1970s. And don't you owe the American people some sort of explanation for what we're going through? I mean, I noticed earlier this month when you talked about Bretton Woods a little bit, and you said that Bretton Woods, the Fed staff had to like change how the dollar, movements of the dollar was impacting the economy. Are we going through something like that now? That, you know, are you having to change how you do monetary policy? Is it that fundamental a change underway? Thanks.
It's certainly a time of real change. You know, from a geopolitical standpoint, from a trade standpoint, from an immigration standpoint, you see this not just here but everywhere. So there's quite a lot going on. It doesn't change the way we do monetary policy in the near term. I mean, but and it doesn't change our objectives or what we need to do. And you know, these things are not really our issues. They're really issues for elected governments. All of those issues are really for elected governments. But there's no question it's a time of real change, and very hard to see where that goes. You know, will it be? There have been many things written about how it's going to be a more inflationary time. That's possible. It's not guaranteed. You know, AI could cut in the very other direction. AI could make people much more productive and push in the other direction. I don't know, though. So, but you're right. But honestly, our focus is a much more practical one, and that is how do we keep inflation low and employment high in the near term. That's really what we're about.
Mark. Mark, hang right.
Hello, Chairman Powell. Mark Hamrick with Bankrate. What is the view about the growing amount of slack in the job market, including the softening in payrolls, the forecast of a modest rise in the unemployment rate, and the ability of workers to demand wage hikes or not in this environment where you have inflation surging?
You don't really see unemployment going up. You don't see increased slack, really. I mean, at the margin, remember, you're at 4.2% unemployment. That was, for many years, that was a extremely low level. It happens to have come up off of an even lower level as we came out of the pandemic. We were as low as 3.4%, but 4.2% is probably at the low end of estimates of the longer run, you know, sustainable level of natural rate of unemployment. So I guess I wouldn't agree with that. And also, in terms of wages, you know, real wages after inflation have been moving up sort of more than was consistent with 2% inflation. They're still moving up at a healthy clip, and I think much more consistent with 2% inflation given a reasonable assessment of trend productivity. So it's a pretty good labor market. You know, you're right that the level of job creation has come down, but so has the supply of workers, the change in the supply, the new supply. So you've seen the unemployment rate remain pretty stable at 4.2. It's been as high as 4.3, but you know, those are good numbers. So it's a pretty good labor market. There's a more concerning thing is there's not a lot of layoffs, but there's not a lot of job creation. The number, if you're out of work, it's hard to find a job, but very few people are being laid off at this point. So that's an equilibrium we watch very carefully, because if there were to be you know, significant layoffs and the job finding rate were to remain this low, you would have an increase in unemployment fairly quickly. But that hasn't happened. It really hasn't happened. The U.S. economy has defied all kinds of forecasts for it to weaken, really, over the last 3 years. And it's been remarkable to see just again and again when people think it's going to weaken. Now, eventually it will, but we don't see signs of that now.
Go to Jean for the last question.
Hi, Chair Powell. Jean Young with MNI Market News. There's been a lot of talk about cuts. I wanted to ask you, why do you think there are no forecasts for rates to rise or even to stay where they are next year, given that the projection for inflation is to rise to 3%, and there's a lot of there's some skepticism over whether those price hikes will be a one-time event?
So there are a number of people on the committee who wrote down no cuts this year, but some cuts next year. So, I think, you know, people are writing down their most likely path, right? They're not saying there's zero possibility of other things. Really, it's think of it as the least unlikely path in a situation like this where uncertainty is very high. I think, again, people write down their rate paths, and they do not have like a really high conviction that this is exactly what's going to happen over the next 2 years. No one feels that way about their rate path. They feel like, what am I going to write down? I mean, what would you write down? It's not easy to do that with confidence. So I would just say it that way. We don't rule things in or out. Certainly a hike is not the base case at all. It's not something people are writing down. But in the meantime, we do the best we can with these forecasts, and I think they're representative of the different forecasts and different reaction functions that people on the committee have. So thank you very much. Thanks.
All right, with that, welcome to Closing Bell. I'm Scott Wapner, live from Post 9 right here at the New York Stock Exchange as usual. That was the Fed chair, of course, following a meeting in which the Federal Reserve made no changes to interest rates, but the outlook was always going to be the most important part of what happened today, as you know. The Fed did increase its inflation outlook. It did cut its growth forecast. A more stagflationary outlook, you could say, steps down for the economy and some steps up for inflation. He did say still that the economy continues to expand at a solid pace, even with all of the uncertainty caused by tariffs. Very importantly, 7 members now calling for no rate cuts this year. That's up from 4 at the last projection in March. Chair Powell saying the Fed is, quote, well positioned to wait and see what happens both on the tariff and employment front. Markets, very interesting story. Green right after the statement, perhaps because the market's like, well, okay, I'd rather have a strong economy than rate cuts. But at about, let's say, 252, 253, you did have some very interesting moves in the market. You had stocks sell off. You had bonds move up, perhaps because of this line. We expect a meaningful amount of inflation, the Fed chair said, to arrive in coming months and need to take that into account. We take all of that into account as we welcome in Jeffrey Gundlach. He's the CEO, CIO, and founder of Double Line Capital. Good to see you. It's always great to have you on these Fed days, Jeffrey. What was your biggest takeaway from what you heard from the chair?
It seemed like kind of a repeat of the last press conference, except I think his messaging was a little crisper this time around. Last time it was sort of like, we don't know anything, which doesn't sound very good. And this time it was sort of a wait and see. And we're getting to a point, I've talked about this at the meetings all year, where we started the year in January with the Fed saying, we're in a great place, because everything was kind of going their way. And now with the adjustments to the SEP in March and now today, they're kind of incrementally moving in the wrong direction. You know, inflation has come down, but as you just referenced, Jay Powell knows, just like everybody I think knows, that there's upside risk to inflation numbers. And meanwhile, the unemployment rate, while it's pretty well contained, there's some very worthwhile, not high frequency, but long-term indicators that are worrisome on the unemployment rate going higher. On the inflation side, you basically know that the base effects, meaning the numbers that are rolling off from a year ago, are very low numbers. On the CPI, there's a 0 and a 0.1 rolling off the next 2 months. So those will probably be replaced with numbers that are higher than that. And so the Fed knows the inflation rate is going to be probably worse at the next meeting and perhaps also at year end. So they upgraded their inflation forecast. The 3 things, you know, you got the base effect I just said. You also have oil, which is up. Obviously, it could be a short-term spike based on tensions, but it's up over $10. It's up 20%. And every $10 that crude oil goes up, if it's sustained, adds about 0.4 to the headline CPI. So we've got the base effect, probably going to add a couple tenths to CPI. We've got crude oil, if it sticks, maybe adding 4 tenths between now and year end. And then you've got the tariffs, of course, which are very unknown. And one thing that's clear from Powell's answers to the questions is he thinks tariffs are inflationary. There's all kinds of arguments that it might slow down, you know, destroy demand, slow down the economy and all that. But it's basically, he believes it's inflationary, someone has to pay it. And that might mean that margins could be incrementally lowered. And of course, we've seen earnings estimates go down moderately for this year. So the mandate keeps getting, the dual mandate keeps running into increasing tensions. And at one point, that's why I think he said wait and see. At some point, one of these dual mandates is going to win out over the other one. And I think, and they're going to have to pick one. And I think they will pick the fighting the rise in unemployment more than fighting the rise in inflation. It seems like we're being prepared for higher inflation numbers that are very likely to happen. And he talks about maybe there's a one-time effect from tariffs and that dissipates in 2026, but maybe it won't. And so we'll have to see what happens with that. But in the bond market, what we've seen is a steepening yield curve. We've seen long rates going up substantially more than short-term interest rates, which is the bond market's way, in my view, of taking sides and saying, it looks to me like they're going to say, we're going to cut rates, even though inflation is probably higher than 3% between now and year end. And so if the unemployment rate goes up, they're probably going to be more likely to cut rates, even if the inflation rate's at 3.5%. The two indicators that I'm really focusing on for the employment rate is the yield curve, of course, has steepened and de-inverted. And the indicator that I think is the most valuable is the 1-year moving average of the 2s, 10s yield curve. Because when it goes positive on a 12-month moving average basis, that's, for the past 35 years, that's been right at the front end of a recession. And it is above now its 12-month moving average. So we're going to monitor that very carefully in the months ahead. The other thing is the U3 unemployment rate, which is at 4.2% now, versus its 36-month or 3-year moving average. And when that crosses above its 3-year moving average, going back all the way to 1990, so 35 years, you've seen that right when it crosses above, you're at the front end of a recession. And that has already happened, but it's not yet, it's not accelerating. In the past, when it goes to its 36-month moving average, it accelerates. That has not happened yet. And so what we're watching very carefully is the continuing claims, which have been rising for the last 2 years, and they foreshadowed the moderate increase we've had so far in the U3 unemployment rate. But continuing claims keep rising. And so we're going to be watching that on a real-time basis, because if that continues to move higher, it strongly suggests to me the unemployment rate will be moving higher. Also, one thing I want to point out is poor Jay Powell has been dealing with 5 years of incredibly unusual data. You know, the money printing, and then the surge in the bottle chain, the supply chain problems, and then the reversal of all of that. And now we have these tariffs, and now we have all these tensions in the Middle East affecting the most important commodity for inflation, which is oil. So I understand his wait and see approach, but in the end of the day, I'm just trying to divine the meaning of the bond market. I think we believe that they're going to be more likely to cut interest rates even against a rising CPI or PCE as we move forward through the end of this year and into 2026. And so I believe that this yield curve steepening is a trend that has been in place for a while now, and I think it's going to continue with the Fed likely to keep pressure lower on short-term interest rates. I do think it's interesting that there is no talk whatsoever of a hike. I thought there were some questions in the Q&A that were relevant to that point, but it's clear that everyone on the Fed thinks that the next move in rates is lower. And that further corroborates my idea that ultimately when the mandate comes into tension, they're going to look for to improve employment rather than to fight inflation, as long as it's moderately above 3% only. So that's kind of my takeaway for the meeting. Not a lot of new information, but it is a very, a lot of moving parts going on with economic data and tariffs and war. I mean, what else can you throw into that equation other than some sort of natural disaster?
It's clear that the chair thinks that the president's tariffs have a decent chance of wrecking both sides of their mandate by pushing inflation up and causing, the labor market to deteriorate at some point. It's just impossible to know at this point which has the potential of happening first, as you say, but you obviously have a view on how they would react, one versus the other. It's interesting, when you were with me last time, you did say that the long end was going to continue to rise. On May 7th, the 30-year was 478. We're at 488, 489 now. I did think it was pretty interesting when You know, the Fed chair has talked about inflation as a result of the tariffs being transitory, but that one line really stuck with me, and it moved the market undoubtedly when he said we expect a meaningful amount of inflation to arrive in coming months and need to take that into account. I think he's saying as a result of all of that, we're justified in not knowing what the next move will be because we just don't know what the impact of all this is going to be still.
Well, I think that's absolutely right. I mean, as I said, inflation is very likely to go up. They know that. They don't want to be embarrassed and to be blindsided by what could be a 1% increase in the inflation rate, depending upon what the tariff effect is. Just the oil effect is significant. And like I said, the base effects are also going to be problematic with numbers coming out probably higher than the ones rolling off. So there's a lot of uncertainty, and the wait and see is right. But it's interesting, you mentioned the 30-year is up about 11 basis points since the last Fed meeting, but the whole curve is up basically by 11 basis points. There's been very little movement. I think the wait and see attitude that the Fed is articulating is very similar to what's going on in the bond market. I mean, there's been very little volatility in rates. The bond market is also signaling a wait and see attitude. And we saw a big drop in risk assets in April, and we saw a great big widening on the spreads of lower credit versus treasuries. Like the high yield index went from 250 basis points over treasuries to 450 basis points over treasuries. And, you know, that has been almost entirely reversed. And the same is true for emerging market debt, which widened out by 200 basis points versus treasuries. And if you exclude Venezuela, which messes up the emerging market spread data because it wasn't in the index and it came into the index and it's very high yielding. And so it created distortion on the spread. So if you want to analyze apples to apples, you just look at emerging markets ex Venezuela, and they're really all the way back to where they started. So everything has had tremendous volatility, but we're all the way back. And the market is starting to look at stresses in parts of the credit market. One thing that's really kind of weird is that the bank loan market, the CCC bank loan market, which is the most vulnerable area of the credit market, in my view, the spreads on CCC bank loans have actually come in this year, which makes no sense to me because CCC lenders are paying 425 basis points higher now than they were a few years ago, and the Fed is not cutting rates. And so the pressure on CCC bank loans is starting to mount because they've fully reset up 425 basis points. Some of these companies are paying 10 or 11%, and some of their, and yet the spreads are in, and yet the defaults are mounting in the CCC sector of the bank loan market. It's very strange to me that the lower tiers of the bank loan market have improved in terms of their prices versus treasuries, whereas regular way high yield, the fixed rate stuff, which doesn't have hardly any pressure on it relative to these bank loans, the CCC high yield market has widened out. So it seems like it should be the opposite to me. But at this point in time, we continue to favor liquidity. We continue to favor avoiding lower tiers of credit, systematically looking to upgrade. I think now is yet another opportunity to do another tranche of upgrading of fractions of the portfolio because we're right back to where we were pre-April 2nd in terms of markets broadly. Stock market's almost fully recovered. It's actually now about as overvalued as it was at the peak because we've had earnings being downgraded, and yet the stock market has largely improved. It's down a little bit from its peaks, but really the valuation. It's funny when markets go down and you go into down 10, 15, 20%. People in hindsight look back and say, yeah, it was kind of overvalued. I probably should have stepped aside, but we're right back to those levels now. And not surprisingly, everyone has forgotten about what they thought they learned on the last drawdown.
Well,
so one thing we're go ahead.
I was going to say we're 2% from a new high on the S&P. Let me just break away for a moment, Jeffrey, and I'll come right back to you because Steve Leisman's left the room, and I do want to bring him in. A couple things are clear here to me, Steve. Number one, it seems the Fed chair believes that the tariffs have put both sides of the mandate into question, and they're going to have to wait and see on how to deal with all of that. and that Powell himself doesn't seem to be a huge fan of these SEPs either. And he revisited the refrain from the last meeting, throwing back at the reporter who asked him the question, what would you write? We'll do the best we can. Because they just don't know, and he pretty much told you to take it with a grain of salt without using those exact words.
Yeah, and by the way, the grain of salt is actually a number in the SEP where they talk about the uncertainty, and those uncertainty levels around their own forecasts, they acknowledge to be very high right now. I guess when Jeffrey was talking, Scott, I remember the day I was on a boat and I had a east-west swell, a west-to-east wind, and a north-to-south rip. The waters are very turbulent right now, and it's interesting. Well, first, let's hear what the Fed chair said about the outlook and what might be coming this summer.
One of our jobs is to make sure that a one-time increase in inflation doesn't turn into an inflation problem. And that, again, that will depend on the size of the effects, how long it takes for them to come in, and ultimately on keeping inflation expectations anchored.
So, Scott, it's something that we were talking about. He did say he expected a meaningful increase in inflation, and that's something I think that's very important for what the market is expecting. And it hadn't seen it. It maybe thought it was out of the woods, but that's not the expectation of the Fed or any of the forecasts that I've been talking about for several weeks now. What is really interesting, Scott, if you take a look at the changes to the forecast, something is gonna not happen there. Here we go. We reduced GDP by 0.3. We raised PCE by 0.3, and core PCE, and we're going to cut the funds rate essentially by 50 basis points. I don't think you're going to cut the funds rate by 50 basis points if you get a 3.1% core PCE. And if that GDP number happens, well, I don't know what happens in that case, but I just don't think you're going to get that 50 basis points of cuts if indeed you're going to have that increase in inflation. That's why I asked him about scenarios, but he wasn't necessarily willing to give me the details on it.
Yeah, he doesn't want to deal in hypotheticals. I mean, he's made that case over and over again. Steve, thank you very much. Steve Leisman, I need to get to Eamon Javers now because the pool was in the White House in the Oval, and there are some headlines coming out of there. Eamon, what do we know?
Scott, this was a president who was very ambivalent seeming about the prospect of using military force in Iran. He was holding a photo op, really, with the Juventus soccer team, which is in D.C. Today for a game. And while he was there, he talked to reporters, and he expressed his deep ambivalence about the idea of the U.S. joining the Israelis in the war against Iran, saying that he doesn't want to fight, but sometimes you have to fight, saying that he's been adamant all along that the Iranians cannot be allowed to have nuclear weapons, saying it's his belief that they were just about a week or so away from getting to a nuclear weapon at the time the Israelis began their attack, and also saying that he's got a meeting coming up in the Situation Room, which he called the War Room, in about an hour from now, Scott. So that gives us a little bit more insight into the decision-making process over the White House. But this is just from tone of voice, body language, the word choice. You'd have to say this president is deeply ambivalent, Scott, about the prospect of U.S. military action. He said he still hasn't made a final decision.
Yeah, thanks for the update. It's Eamon Javers for us in Washington. We're back with Jeffrey Gundlach now. And I guess you could say, you know, even these developments, Jeffrey, in the Middle East are a reason why there's so much uncertainty on how this is all going to play out, what oil prices do from here, as you suggested. It's a great unknown. I want to discuss with you what Steve sort of ended on, the idea about the outlook itself, why the Fed even does it. David Rosenberg yesterday said something on social media, and I want to quote from it, and I want to have you react to it. He said, I have some advice for the Fed. Ditch the dots. In fact, do what many CEOs have been doing in general and pull out of the guidance. In the context of the supremely high level of economic uncertainty, any numbers this group publishes will be completely meaningless. He is not the only one who has suggested that theme. What are your thoughts on that?
I don't have much of an argument with where it's coming from, but I don't see how the dots hurt anything. I mean, yes, there are a lot of uncertainty in them. There's volatility in it. Nobody can see 2 years into the future. Jay Powell said that himself. But I like the dots because it gives you a sense of the nuance of how the Fed's thinking and how their interpretation of the data is changing. I don't put a lot of faith in the numbers. I don't think anybody does. But I like the fact they provide context for us to think about, we don't hear a lot of straight talk from the Fed. They try to do a pretty good job at these news conferences, but it's good to see those subtle changes. One thing that Steve said is, who knows about these numbers on the SEP, but I do think it's quite possible that the unemployment rate ends up being higher than what the Fed thinks because of things I talked about earlier. And so I do think that's going to be the focus as we move forward. We already know with some certainty that inflation's going up. Jay Powell said so himself and fairly strongly. So the real question is what's going to happen with the unemployment rate. They say it's going up to 4.5. That's a 0.3% increase. If it goes up to 4.7 instead of 4.5, I think the Fed's in cutting mode, almost certainly, regardless of whether the PCE is at 3.1 or 3.3. I think that's what they're going to favor. But I like having the dots.
Oh, it's good to hear your perspective on that. If you think the longer end and yields are going to continue to back up, I mean, are we talking 5% on 30-year, the 10-year? I mean, where do you see it peaking out if it does move according to what you think?
I have this theory that we are in this market where rates are rising because of the deficit, of course. We're going to hit 37 trillion on the national debt. Maybe, I think it's this week. We're at 36 trillion 996 billion or something like this, and it's rising quickly. So that's one of the. But we also have long rates rising all over the place. Even Japan is way above where they used to be. Japan and Germany, interestingly, are now at the same level on their long-term bonds. And of course, that's UK rates have gone up like the United States. US rates are up. And so a lot of this, I think, has to do with all of these debts and deficits. And so that's a big variable in steepening out the yield curve. And compounding that, just to repeat myself, is that the Fed, I think, is biased to cut rates, even though inflation is, by their own estimation, going higher. Another thing I want to talk about is in the past, I've talked about foreign stock markets being more attractive than the US stock market. And something very strange has happened this year. If you go back 15 years, there's been 13 corrections in the S&P 500 over the past 15 years. And in the first 12 of them, in every single case, when the S&P corrected down more than 10%, the dollar went up in every single case. And the dollar didn't go up a little. It went up by about 6 or 8%. In the correction in March, April of this year, the dollar went down. And that's the first time that's happened in 15 years. And this is what I've been predicting, is that the dollar will go down as you get into periods of fear and weakness in risk assets. That certainly played out in March and April. And yet, the dollar continues to weaken. It's interesting, the S&P 500 has improved back almost to the high previously, and the dollar keeps falling, even though rates have been rising. All of these things are very different from the past, which reinforces my core belief, and I've been stating this for a while, that when we get trouble, the dollar is not going to be a safe haven currency. The dollar will fall as we run into trouble. Now, one robin doesn't make a spring, so the fact that this happened in the March-April period corroborates my theory, but it doesn't prove anything yet. But I'm quite committed to this theory. Now you ask, what will happen? Where can rates go on the long end? I feel that we'll get to a point where we start to have a real buyer strike on long-term 30-year treasuries, just like you have had on long-term JGBs. And it might get to the point where there has to be something done about it, because we have doubled the interest rate on the treasury debts over the past 5 years. It used to be in the high ones, like 1.8 entering 2020, and we're headed towards 4%. Because all the bonds that are rolling off that had those 50 basis point and 25 basis point coupons, a lot of those are coming due, and they're being refinanced up 400 basis points. So the pressure on the interest expense is going to continue, and it may get to the point where there has to be something done about it. And so one of the things I'm thinking about, I've been avoiding long-term bonds broadly, and that's been the right move because that's been the worst place on the curve. But I think you might get to a point where it becomes uncomfortable, very uncomfortable, for the government to be floating debt at what people are willing to buy them at, particularly if we're in geopolitical turmoil, which hopefully we won't be. but we may see a pivot to a program of controlling long-term interest rates. And if that's the case, you might have one of the hardest decisions in the Treasury bond market that we've had since the global financial crisis, where you had to pivot from very, very high quality long-term Treasury bonds into bombed out credit. And it takes a long time for these things to happen, but that you have to make a decision as to when to pull the trigger. There might come a time where they decide that they announce that they're doing quantitative easing, and they're going to focus on trying to get mortgage rates down and 30-year Treasury rates down to fight the interest expense problem. And you may get an announcement. And if you do, then suddenly you're going to have a monster rally in long-term Treasury bonds. So there's going to have to be a pivot. I've been talking to you for quite a while about not liking long bonds and liking shorter term or the belly of the curve. And that's been a very good strategy. But at some point, there'll be a moment where an announcement could come up and you might see a 15-point increase in the prices of long-term Treasury bonds in like 2 days or a week, kind of like you saw in the corporate bond market back in 2020 when the Fed announced that, or the Treasury Department announced that they were interested in perhaps buying corporate bonds to support the completely frozen credit market in the aftermath of the lockdown. So we have precedent on these sorts of things. And so that's really top of my mind regarding the long bond. Avoid presently and look to potentially have to do a fairly large pivot. Now, I know that everybody is kind of not, I don't know anybody that's pounding the table to buy long-term Treasury bonds, except maybe Dave Rosenberg, who has been very fond of long-term Treasury bonds. I keep telling him I think he's early. But it seems like everybody is avoiding long-term Treasury bonds, which exacerbates this problem, because once the trend is in place, as it is, people just think, wait and see, I don't want to commit myself too early. But everybody's been right. It's just like going up in credit entering 2025. That was a popular theme in the bond market. And a lot of people some of my big clients were saying, you know, everybody's talking about these trends that you're talking about. And I've learned that when everybody's on the same side of the boat, you know, maybe it's time to switch sides.
Right.
But that hasn't been the case. Sometimes the consensus is right. And I feel like it is right now.
Let me squeeze a couple things in before we run out of time. And you commented on the dollar, and there are hypotheses abound, obviously, about why the dollar has been acting the way it has, which is certainly against historical norms. The flight to safety trade into the world's reserve currency hasn't worked out so well. Some have suggested it's because of the U.S. exceptionalism idea, and that trade going out the window because of the way that the White House has maneuvered and managed the whole trade issue and some of the other global relationships that it has had for decades, which are now changing. How would you assess that? And then I want to ask you one more thing before we go.
Well, I don't think saber rattling or tariff rattling is really helpful. I don't think it encourages foreigners to buy dollar assets. And foreigners have been very willing, downright enthusiastic, almost euphoric about buying dollar assets over the past 18 years or so. Over $25 trillion have come into, been invested into U.S. financial markets, more than the U.S. has invested in foreign markets. That's a massive increase. It went from $3 trillion to $28 trillion by one measure. That may be reversing, and this is part of the underpinning for why I think that the trend of U.S. outperformance is over. And I mean, like, over for real, like Europe outperforming. If you're a dollar-based investor, I've been recommending Europe in European currency for dollar-based investors. The index has outperformed the U.S. index by a decent amount. But if you had the currency side of it, if you own it in euros and you get the currency translation, I mean, you are just printing money right now. And that trade, I believe, is just getting started. And it's gotten to the point where even the emerging markets are starting to perform on an index basis. And so I advise dollar-based investors, don't do this with all your money, but certainly 10, 20%. I would take of my equity allocation, and I mean on a $100 portfolio, I would take $10 or $20 of the $100 portfolio and put it into local currency emerging market funds, whether it's fixed income or equity. I like it on both sides, particularly on the equity side for now, because the volatility is so high on the bond side. The currency adds so much volatility that you're almost in a different asset class when you take currency risk in a bond fund. But when you do it in a stock fund, the stock volatility is so high that the incremental volatility from the currency is not that big of a force accelerator. So that's kind of how I see it. I really favor non-U.S. markets. I think people should invest in Germany. I think India, perhaps Mexico, I think are good areas to invest with what used to be S&P 500 money.
Do you think gold is still going to 4,000?
Oh yeah. It's very high right now, but it's a clear beneficiary of everything that's been going on. I mean, it's the one asset class that's really doing well this year. And I think the demand for gold is for real. A lot of it's from foreign central banks have reversed all of the selling. They sold for years, and they sold at low prices, and now they've bought it all back. They're right back to where they were before they started selling it down. Of course, they're buying it back at 2,000 and 3,000, and they sold it at 300 and 400. But I think that's going to continue to be a source of buying. And I also think that real money, institutional money, not just survivalist lunatics and crazy short-term speculators who used to be the gold market, it's an asset class, and it's thought to be a storehouse of value for real when we see all of this profligate spending and borrowing in developed countries. That's another reason why I like emerging markets. They don't have the same same position that they do in Japan, the United States, and the UK.
Do you have any concerns at all about some reporting that the president could possibly name Chair Powell's replacement well in advance of his term ending, creating what some have coined a shadow Fed chair? I mean, do you worry about that and wonder what the market reaction would be?
Well, I know what the market reaction would be. It would be a corollary, the same thing as what I talked about quantitative easing. If there was some ultra dove or sycophant that came in there that was just going to do whatever Trump wanted him to, and let's say that he announced the appointment, before the end of Powell's term. So you've got this, what people call the shadow Fed chairman. If that shadow Fed chairman would make pronouncements that the minute that he's approved and gets into the chair, that he's going to cut interest rates 200 basis points. That talk like that could really accelerate some of these trends, because people would start to say, I mean, I think it would begin with a rally, unbelievably, in bonds. Even the long bond, I think, would rally on such a statement, although it shouldn't. If such a statement were made, the long bond should go to 6% very quickly, but probably because people have been informed of past patterns in markets that are informed by a secular bull market in long-term treasuries, which is now a secular bear market in long-term U.S. treasuries, at least for the time being. What the relationships a lot of people react to in high frequency are not working. Just like the one I talked about with the S&P 500 going into correction and the dollar going down. We're in a different regime right now than we were from 1980 until 2020. That's at the core of my investment philosophy moving forward. And so far, it's been playing out pretty much according to the game plan. So it's going to be one of these environments where right now there's almost nothing to do. There's no volatility in the market. Even in the equity market seems to have stalled out. It kind of found its way to 6,000, but it doesn't really go above 6,000, doesn't really correct much. But then all of a sudden, we're going to see a lot of volatility. Low volatility is always replaced with high volatility. And the variables that would lend themselves to high volatility seem to be pretty much in place under all these things that we've been talking about with inflation and tariffs and war. Like I said, what else do you need to cause uncertainty and volatility? So it should be coming as we move into I'd say probably Labor Day type of period towards year end.
Jeffrey, enjoyed it as always. Thank you so much for the time. We will see you following the next Federal Reserve meeting. It's Jeffrey Gundlach joining us once again.
Thank you.
Take care. We're now in the closing bell market zone. CNBC senior markets commentator Mike Santoli with us for these crucial final moments of the trading day. Coinbase and Circle are surging. Tonight, McKeel has the details there. Mike, go to you first. What do you make of the market's reaction to what the chair said?
I think it's probably the dream reaction for Jay Powell himself and for the Fed, because they are resolutely non-committal. They're kind of telling investors, probably for 3 months, you're on your own. I mean, what would have to happen for late July, that meeting to be live with a cut, is bad stuff, right? Because you only got one more monthly jobs report, you got 5 more weekly unemployment claims. It's not going to happen. Therefore, they're kind of wishing that they don't see an emergency in either direction, and we're fine. It leaves investors in a position of rooting for the economy to perform well. You're not going to root for weakness, because it has to be really weak for them to move right here. I do think it shows you a very high threshold within the dots for doing anything right now. And by the way, if you replace the Fed chair, that Fed chair doesn't have the votes to be cutting much anytime soon, unless you want to blow up the whole committee structure. So let's not even talk about, I don't even think investors have to think about that, because I also think the president prefers to have a foil here.
Yeah. Tanea, Coin and Circle making big moves. What's going on?
Yeah, that's right, Scott. Big pop in both Coinbase and Circle after the Senate passed its landmark stablecoin legislation, the Genius Act. Stables have attracted a groundswell of interest in anticipation of regulatory clarity for their ability to make payments faster and cheaper. It's actually been really good for ETH ETFs, which have come roaring back from the dead this month. A lot of these stablecoins run on Ethereum. And so with that, Coinbase is unleashing a stream of crypto innovation beyond trading, which is its core business. It introduced Coinbase Payments this afternoon. That's a product from merchants that lets them accept payments in USDC. You got a glimpse of that in Coinbase's partnership with Shopify announced last week. And so if we are in this new age of stablecoin payments, that could eat into revenue at the card network. So some on Wall Street saying that fear may be premature, but nevertheless, Scott, Visa and MasterCard taking a hit for now. And USDC issued, of course, by Circle, whose shares are rocketing up more than 500% since IPO earlier this month. Scott?
All right, Tanea McKeel, thank you so much for that. Back to you, Mike. I mean, it feels like a dream scenario, since you use that, for the Fed would be you come in July, you sort of give the same kind of repeat, not exactly sure, economy's still in a good place, inflation expectations are up, maybe up a little bit. You get yourself to Jackson Hole, and you set the table if you feel you absolutely have the clarity at that point, and then you do the cut in September, like many think is on the table anyway.
Yeah, and the question is, in August, during Jackson Hole, are you going to have enough data then in terms of what the inflation impact is and whether it's going to be sustained of tariffs? I do think there's a fair argument to be made that they should assert whether they think mostly you should look through that inflation or not. I know they want to just kind of sort of forego any real opinionating on that and leave themselves open. But yeah, I think that is the dream scenario, is that you're able to do more of these normalization cuts, these kind of, quote, peacetime normalization moves, as opposed to responding to a rapid weakening in the employment picture. I think a lot of people are really attentive to the softening of the internal labor conditions data, really, anchoring to some of the softer inflation prints right now, looking at housing,
guys,
and feeling like the downside risks have increased more than the Fed is acknowledging. And if the Fed is going to essentially hide behind a 4.2% unemployment rate and say it's going to 4.5 by the end of this year, and going to kind of stop there, then maybe there's going to be some tension between how the data come in and that. For now, the economy is not necessarily in a desperate spot.